Okay, I think we can get started. I haven't figured out quite yet how to use the waiting music on Spaces, so do apologize for the blank space there. But today we have Tony Marino here, CEO of Tenaz Energy. We have a new, welcoming a new company to our Twitter Spaces, which we're looking to restart here in a more scheduled way moving forward with some of the quarterly releases and whatnot coming out, and especially for some of the junior companies, nice little opportunity to come up and kind of speak directly to retail on this platform. So welcome, Tony. We'll just make sure once again that your mic is working, and then we can
Uh,
sort of get started here.
Great, Shubham. It's a pleasure to be on here. Can you hear me okay?
Yeah, you bet. Everything is fantastic. So if you are in the space and you are part of the com group or just interested in Canadian oil and gas in general, please feel free to share the link in the group chats or on your feeds. And yeah, we'll get. So I think we'll get started, Tony, with just an introduction on yourself, kind of what your background is, where you've worked, when you started as, and that'll give everybody a chance to get acclimated, and then we'll begin with the Tenaz focused questions after that. Thank you.
Okay, for sure. Yeah, thanks so much, Shubham. First time for me on Twitter Spaces, a new way of explaining the company, and looking forward to doing it today. And I want to thank everybody who's hooked into this call. So, you asked for my background. I don't think it's, super important. Maybe really, it's about our entire team. But I'll say that I'm a petroleum engineer, MBA, CFA. Um, Spent a long time in the industry, longer than I would care to admit, probably. Uh, Going on 40 years since I began working as a petroleum engineer in California. But I have a pretty strong technical background from the very basics in the industry. I have spent a lot of my career in M&A evaluation and then ultimately negotiation and leadership of M&A programs. And I ran a few Canadian intermediate-sized companies. Dominion Exploration Canada Limited, which is at the time was a division of Dominion Energy, D on the NYSE. I was with Baytex for 8 years, and then from '04 to 12, and then Vermilion from 12 to 20. And kind of shortly after the pandemic bottom, a group of us from the management and technical ranks at Vermilion formed Tenaz. Uh, we formed the company with the objective of uh, making international acquisitions, primarily overseas acquisitions, where we saw typically greater value and better opportunities for improvement, maybe than we could find in the domestic market. We decided on a recapitalization of an existing Canadian public company as our vehicle to conduct these acquisitions and finance them over time. That vehicle that we recapitalized was Altura. The team that we put together consisted of the C-suite that we have at Tenaz consists actually all of ex-Vermilion personnel. Our CFO is Brad Bennett, who was a treasurer at Vermilion, and our COO is Mike Kaluza, who had the same position at Vermilion previously, and a technical team that, while it's not entirely ex-Vermilion people, has a significant representation there, and we've added some very key elements to that technical team from some of the other successful Canadian companies. So, by and large, it's a team that's been together for a long period of time. Some of us date back more than 20 years now, so we're, I think, quite like-minded and quite dedicated to the same set of objectives, which is really shareholder value running this model that I talked about. Uh, and I'm sure we'll get into the company more, but with its primary focus being around the international acquisitions, we also have and received via the recapitalization of Altura a very strong project in Canada that we're continuing to develop and making some technical adjustments and improvements in to further improve its already strong economics. That's kind of the background on Tenaz, TNZ, traded on the TSX.
Right on. Appreciate that background. I think it's definitely an interesting time to be in the call it the junior to small cap space, and definitely in your background as well. You've come from some major companies, Baytex and Vermilion, and then now into a smaller, more specialized vehicle, let's say, for a certain business plan there in Tenaz. So I guess tell us a bit more about Tenaz. What's the production like? How are you running your balance sheet? And then sort of some of the things that have happened since the recap. So you recapped, you bought Altura with, as you mentioned, the Canadian asset, and sort of how things gone from then. Obviously, a couple of years there of COVID and lower prices, but looks like you're set up really well moving forward. Thank you.
Yeah, well, we think we're very well set up. So, um, yeah, to begin with, maybe we'll talk about the recapitalization and the existing asset, and then I'll try to segue to the main thing that we emphasize, which is expanding the company internationally. So, you ask about the size of the company today. First of all, I'll characterize that just in terms of production. If we don't make any further deals, we would be at about 2,250 BOED for the year. That's our public guidance. We, although we work a great deal on this transaction pipeline, and we're very optimistic about our prospects for making additional deals, we don't put anything into the guidance that we don't already have in the portfolio. So 2250 BOED, that compares to a start with the recap that we had of about 1,000 BOED expansion in Canada and the Netherlands asset that we added at the end of last year. Um, and I'm sure we'll have a chance to go in a little bit more into the growth profile in both parts of the company, the domestic and the international. Um, in terms of the balance sheet, the capitalization of the company, we don't employ any debt today. We, on a net basis, we have negative net debt of 14 million Canadian as at the end of the year. Um, we do have a bank line that's unutilized at this point. It's undrawn at this point. 10 million from ATB. That is really uh, just a pretty small credit facility that's based on the Canadian asset at this point. So that is the capitalization, quite a bit of liquidity for a company of our size. Uh, the public market cap is only about 60 million, and then to get to the EV, you would be taking off that negative net debt number. So that is where we stand today with the company size.
Yeah, right on. No, thank you for that. I think just a quick reminder for everybody: the slides that Tony and I will be discussing are in the nest up by the where the title is. So if you are looking for that, you can have a look over there for sure. So I guess you mentioned the recap transaction, Tony. There's also the assets that came with it. So maybe before we get into the pipeline of new M&A that Tenaz is obviously focusing on, maybe let's have a quick discussion over the legacy assets and then the Netherlands transaction as well. So the Leduc Woodbend obviously came from Altura, a very nice geologic find, a one of the biggest semi-conventional fields here found in the little bit. Looks like Tenaz has a low growth, cash flowing plan for this asset. Is that correct? And then how do you see this asset going forward and as a development throughout Tenaz?
Okay, yeah. Thanks for that intro on Leduc Woodbend. So this is a conventional trap, a low but not ultra tight permeability conventional oil field that Altura found. And actually it's really a great credit to Altura that they were able to identify this field at a shallow depth that I'll point out right now that Altura was founded and run by David Burkhardt, who was with us as SVP in our operating group. He was the CEO of Altura, and it was his company. But by the way, we had worked with David previously at Vermilion. He had run our French unit, so we knew him pretty well, and we were made it, I think, more possible to do the recap given our previous work together and confidence that we had in him and that he had in team that we had assembled for Tenaz. And again, a real credit to David for and his team at Altura for locating this field. Um, it's only about, I don't know, 20 kilometers or so from uh, Leduc, not very far from Edmonton. It's in a great spot in terms of its surface setup, excellent access to um, the transportation network, to the highways, close to the city, which gives us a ready and very highly qualified labor force in the field, good access to services, not very densely populated in the immediate area around the field. So positive, I think, from a standpoint of all the surface access. More importantly is what's in the subsurface, what they were able to identify uh, uh, in this conventional trap that exists at the Manville level. Specifically, the current member that we're developing within the Manville is called the Rex. It's at a depth of only about 1,300 meters. It had been drilled through many previous times on the way to deeper targets in the area, and it's a low permeability reservoir. You can see it there on the logs, but it doesn't really stick out. And Altura recognized this as a desirable target for horizontal drilling. Um, Altura started that development. By the time um, we did the recap, it was producing about 1,000 BOED. We built that about 20% in the first year of Tenaz to 1,200 BOED last year, and we're guiding to a midpoint of about 1,500 BOED this year. So actually, it's a good percentage growth rate, and we think that those kind of pretty good percentage growth rates can continue. While we do that, given the high returns on the horizontal drilling here, we should be generating quite a bit of free cash out of the asset. Um, uh, it's a kind of a low to intermediate gravity oil, trades at a WCS price, actually usually a little bit better without any diluent being applied. Um, and of course, it uses horizontal wells with multi-stage fracs to enhance the productivity. At the time that we did the recap, Altura was drilling wells in the range of about 1.5 miles in length. I think they started off at about a mile, mile and a quarter, and they've been moving up in length. We've since expanded that, reaching just almost a 2.5 mile length on some of the recent drilling. And this is a kind of the steady technical improvement that enables us to bring down the development costs, improve the recycle ratios, improve the free cash generation of the property, even as it continues to grow. There have been other changes in the frac recipe that have helped us get to basically 100% frac placement on somewhat tighter frac spacing maybe than had been used in the field previously. We've had improvements to the geologic description that allowed us to keep the wells in zone, and that's also a major factor in getting this close to 100% frac placement. So uh, it's a good field to begin with. Quite an amazing, I think, find that Altura made. As you mentioned, it's one of the bigger conventional or semi-conventional pools to be found. I think if you map it all the way to the field limits, you can place upwards of 500 million barrels of oil originally in place. We have I would say almost the entirety of the main developable part of the field under lease. Sometimes we're able to make little leasing expansions in it, but really we've got most of it locked down. It has quite good infrastructure for longer term growth. Without too much infrastructure investment, we can continue to grow it at this pretty good percentage rate. Probably ultimately can reach double or a little bit more, maybe close to triple the existing field size. And we think under a reasonable price scenario, all the while that we'll be doing that, we should be throwing off free cash, which is really the ultimate objective of the company. So that is the Rex member development in this Leduc Woodbend field that constitutes our Canadian asset. That asset at 1,500 BOED is about 2/3 of our guided rate for this year, again, absent any other acquisitions, and the other third would come from the new Netherlands asset.
Awesome. That's a very, very detailed description there. And it's always nice for a junior company to have not just a cash flowing asset, but one that you can then grow, and it just gives you this free cash flow and growth to fund your other part of the business plan. So when we look at what else Tenaz is doing, there was a recently announced a transaction in the Netherlands. You bought some offshore production along with some infrastructure as well, and a very creative transaction, we can say, where Tenaz took on some of the decommissioning liabilities, paid a very little upfront for this transaction, and an area that you would be familiar with given your time with Vermilion in the past and their assets up in Europe and the Netherlands. So I guess if you can just provide some detail on the transaction and maybe some information as to how the deal was cultivated such that it was very, very cheap upfront price to Tenaz, and yet gives you the production capacity along with the some of the pipeline and other infrastructure, I believe, that also came with it, sets the company up again very, very nicely.
Yeah, Shubham, that's another nice setup description for the asset. And for a minute here at the beginning, I'll just zoom out to the overall strategy that we have internationally. So, and then I'll get into a specific discussion of the asset and the transaction. So the main objective that we have in Tenaz is to make acquisitions overseas, and the list of geographies, kind of in order of preference, would be first in Europe, where, as you point out, we have a great deal of experience previously. Secondly, MENA, where the personnel in the company also have a great deal of experience. By MENA, I mean Middle East, North Africa. And thirdly, it would be the Americas. Latin America, and some potential, I would say, for optionality anyway to make deals in Canada. Of course, we have a great deal of experience both in Canada and the United States. Had a lot of success in the past making acquisitions and then improving the performance. But I'd say it's still kind of a tertiary emphasis of ours. We do feel that there's a number of advantages in the international market. First of all, they typically do occur at lower multiples than you find in North America. So there's kind of this has been true actually for a long period of time, and multiples, I would say, have come down for private assets and, as you know, in the public market as well throughout the world over the last few years. But they still, this differential exists where they're still lower overseas in terms of entry prices or multiples than they are in North America. And so when you have that, it translates, in the way I think of it, into a higher base rate of return, typically on acquisitions in the overseas market. You get a second element that I think is advantageous overseas, and that is that typically the opportunities for improvement in these assets are greater than you have in North America. And that's just because the North American industry is really quite an efficient one. It's been an industry really that's had a number of big technological innovations, horizontal drilling with multi-stage fracs being the most prominent of those, but a number of technological innovations that have been adopted on a widespread basis over the past 20, 25 years. And it's really made the companies much more efficient on top of a very demanding capital market, really a very competitive kind of dog-eat-dog industry in the domestic market. And it means that the companies are much more efficient than they have been in the past. And I would say, our experience is that they're much more efficient in the North American industry than they are overseas. As a result, when we make a deal internationally, particularly when we're the operator, specifically when we're the operator, there's a much greater opportunity for improvement in the performance of the assets overseas than for deals that we make in North America. I would say in our experience in the previous companies, we made Canadian deals, we made even US acquisitions, and we were able to improve how those assets perform. But still, the opportunity for folds of improvement was greater when we bought internationally than domestically. Uh, and oftentimes when you're buying overseas, there just hasn't been the same degree of technical scrutiny and kind of operating efficiency applied. Oftentimes you're buying from some of the larger companies. They could be ex-NOCs. They could be some of the majors that, while they're good at a wide range of projects, specifically really the bigger end of the spectrum, these mature fields that we would be buying aren't really their forte in terms of being able to bring down the unit costs and produce growth out of some of the more mature assets. So it's more desirable typically to buy in that overseas market. And the other thing that the overseas market offers, I would say, particularly in European gas, is a better priced market that has higher margins than you would typically find in North America. Brent continues to trade at a decent premium to WTI, but for the crude market, but for gas, there's a substantial difference in the gas prices, and that's a difference that has persisted even with kind of some of the normalization that has occurred in European gas over the past couple of months. So still, a price advantage overseas and a margin advantage. So our first transaction that we made is in the offshore Netherlands. It happens to be, in this case, a non-operated asset. Certainly the preference that we have in the company is for operated assets, because then we can get at that second type of improvement in operating results as we go forward. This one, though, is a non-operated acquisition that is really quite high rate of return from the very beginning. We've got a competent operator in there, and so we're quite satisfied in this case to be in the non-operated position, even though most of the deals we make would be operated. It's in the offshore of the Netherlands. This is a very important province historically, and I think to the future of Netherlands and European gas supply. A little bit more difficult to operate onshore there, and so there's really, I think, all the investment, all the emphasis going forward for Netherlands will be in offshore assets where we made this first deal. It's a series of fields primarily operated by two quite qualified and good independents there, major independents, Neptune and Wintershall. The rate on the asset is about 750 BOED. So in the range of 4.5 to 5 million cubic feet a day. Yes, the fields are mature, but actually they still offer a number of opportunities for development going forward. Pretty low base decline, in the range of 10% or maybe just a couple percent more than that on kind of a no capital basis going into the fields. There are a lot of opportunities in the existing well set to effect workovers, improvements in the production systems for these wells that can change that decline rate. In fact, if you looked at the period before the acquisition, we kind of look at the end of 21 to the end of 22 at the time that we made the deal, the property was about at the same rate as it had been a year earlier. And there's a number of already discovered gas fields and a couple of significant oil fields that have not been developed within this portfolio. So we think it's actually a very strong asset set that is going to perform pretty well over a long period of time. There is abandonment liability that goes with it. And the way we structured our transaction was to post security for that abandonment up front, take on the abandonment liability, and make through that this acquisition from a meaningfully sized private U.S. company that was refocusing its operations to the lower 48. So that's how we made the deal, and assets are going to throw off, we think, a lot of free cash and really offer surprisingly good opportunities in a mature set of fields for maintaining that rate and even driving it up going forward. On top of the upstream assets that we got at that 750 BOED, all European gas, uh, we got about an 11% interest in a midstream gathering system called NGT. It covers about 1/3 of the Netherlands offshore industry, gathering gas for a variety of operators. It's been a pretty stable source of income over the past over a long period of time, and we project that that's going to continue going forward. Um, so we're very happy to have that midstream asset, which effectively defrays OPEX on our set of properties. And actually, it's got a third optionality for the longer term, and that is that these fields, as they deplete, are well suited for carbon capture and storage. And the operator there has identified the potential for a pretty large CCS project, which would do a couple of things for us. We'd be an investor in it as long as it offers significant rates of return. That's still to be determined, but we're optimistic about that. That perhaps the project can be developed at competitive returns, and it would give us actually, goes into if it goes into CCS operation, it would defray our carbon signature all the way up to about roughly 50,000 BOED, perhaps even higher, if it's continued to be additional fields are continued to be placed into CCS operation over time. So a number of significant advantages to the deal: a good upstream asset with a lot of free cash, a midstream asset that'll produce income fairly steadily over a long period of time, we think, and then this long-term CCS potential.
Right on, absolutely excellent. I think there's definitely some opportunity in these kinds of transactions where the majors are not only looking, well, majors and bigger companies may be looking to exit these assets. They don't want the CO2 signature anymore. They don't want the decommissioning liabilities, and companies like Tenaz can come in and purchase them for strictly just putting up the bond there and kind of taking advantage of that. And then as you mentioned, the carbon price in Europe is about $130 Canadian per ton. So a lot of potential here to not just take away your carbon signature, but to possibly sell those credits as time goes on, and it becomes a secondary sort of free cash flowing stream. So just a little reminder, we're about halfway through this discussion here with Tony, CEO of Tenaz Energy. If anybody would like to come up and ask questions from the audience, please just press that mic button on the bottom left, and we can get you up here. So while people kind of think about that and come up, Tony, I guess I'll ask you the $1 million question. Is obviously you were in Baytex when we had that cycle from '04 to '08, and then the recession, and then we came up to 2012. Vermilion, of course, as well, 2012, and then 2015 we had the drawdown, the big shale boom. What are your thoughts on kind of this cycle now here moving forward? Looks like the world is moving more towards the unconventionals, high declines. Oil, it seems to be getting harder to find. Any thoughts or comments as to how you see this cycle here playing out?
That's such a great question, Shubham, and it really makes me think back to the uh, how different this industry is today versus when we started that period. You know, it was really that period that you covered from '04 to 20. While we did have some up periods in there, especially prior to the financial crisis, it was a very tough kind of grinding period for the industry, and probably the last 5 years of it, 15 to 20, were the kind of in a way the toughest of them all, with a huge growth in the shales in the U.S. kind of and Canada too, kind of restraining prices. Um, a lot of investment into the industry during that time, um, and it's a very different picture, I think, today. As you point out, there's a much higher decline rate in the global industry. You've had a pretty big component come in from the ultra tights in North America. Um, there really isn't nearly as much investment going into the upstream industry uh, today and projected, I think, for the next couple of years doesn't look like it's going to change that much compared to uh, even 5 years ago. 5, 6, 7 years ago, we have a bigger industry today. There's higher global demand and production balancing, of course. Now 102 million barrels a day for oil, a much larger global gas industry, and so. Despite the technical improvements that have occurred, it seems to me that we're going to need much larger investment levels to balance the market. Either you have to balance it at current prices through having more investment, or you're going to need higher prices to balance the supply that is available. You can't have demand go up forever, I think, and expect to call forth that corresponding supply at current prices. And I don't think you're going to get that with the amount of investment that's going into the industry today. So, looking forward, I think the fundamentals are pretty well set up. Every day in the commodity markets, there's these conflicting forces, concerns about near-term demand, about the many financial crisis today that exists in the U.S. banks. All these things that we focus on in the near term, but what I think the fundamental story is that to me, I don't think there just is not enough investment going into the industry to balance the market where we are today. That would be the bull commodity case, for oil and gas.
Yeah, I believe there's many of us in the room who would agree with you and have our money invested in that exact thesis sort of playing out, especially with the lower for longer cycle we had. I mean, that was a 5 to 6 years of no investment in exploration or conventional oil major projects for that matter. So I guess we can dig into that just a little bit deeper. What do you think has changed in terms of the junior company market since 2010 to 14? We had hundreds of junior companies in the Canadian oil and gas space back then. People would take risks, go and drill vertical wells, do a bit of delineation, wildcatting. The capital markets were pretty good. You could go out and raise money. The regulatory system maybe was not as tight as it is now, and Tenaz being one of the few now that are call it sub 5,000 BOEs per day at this point. How do you think that market has changed, and does it really restrict that investment coming in if smaller companies can't come in, get a bunch of capital and go out and spend it, as far as the exploration or the increase in supply that is required to kind of hurt the bull case, let's say, over the next few years?
Yeah, well, I mean, I think as you put it there, you kind of illustrate in our current segment of the market, these small caps, the difficulty in getting investment into the industry, and this problem, in a way, or this underinvestment, actually occurs really throughout the size spectrum in the industry, but for different reasons maybe than it does in the small caps. So you get to the very large companies, it's more of a voluntary decision that they've made to return capital via buybacks and dividends to a much greater degree in the past, and that's sort of the reinvestment picture at the big end. At the small end of the industry that we're dealing in, with Tenaz being a growth company, certainly aspiring to get up to full mid-cap size, at least mid-cap size, putting maybe a 5-year target on it. And for us, that size, that bogey that we use would be in the range of 100,000 BOED. Of course, ultimately, we're not volume driven, we're value driven, but it's a good way to kind of characterize where we want to get to have kind of capital market scale and operating scale in the areas that we're going to be focusing on. But currently, we're in the small end of the spectrum, and for sure, it's more difficult, I would say, for the small companies to finance than it was previously, and it kind of occurs actually on both sides of the balance sheet. Bank lending, which used to be a staple really of companies throughout the size distribution in the industry has been restricted for sure. This was a relatively low cost source of capital, and one that uh, was previously pretty reliable. To a significant extent, it's been withdrawn. In our own case, we have expanded the bank line available to Tenaz from the levels that existed at Altura, but it's still, our bank line of 10 million is still small, I would say, in comparison to the long-term aspirations of the company. Presumably, it will grow over time uh, as our company gets bigger, and maybe we place a little bit more emphasis on having that available to us. Currently, we're not drawing on it, so it's not really critical to us. Equity markets have certainly changed over this period of time. Um, the asset management business changed so much with, you talk about the consolidation that we saw in the oil and gas operating companies. Well, there's been a tremendous consolidation as well in asset management. And so it has changed the way that companies in Canada or the US or really worldwide would go about raising money. And I think this Twitter channel that we are on today is an example of that. Rather than immediately turning to big institutions to source capital and to support and to source, let's say, buying demand for the stock day to day in the market, there's much more of this direct marketing to retail investors, whether it's small retail, high net worth, family offices, small institutions. There's more emphasis on this part of the market, and it's a different medium for accessing them. And what we're doing today is an example of that. So I would say there is less overall capital available, probably less capital available for a number of these organic growth companies in Canada. And it means you have to work harder to raise money when you want to expand the company. Now, for us, in the organic part of the company, we're self-financed. We have free cash coming out of both sides of the business, both Canada as it continues to grow, and significant free cash contribution even from this initial Netherlands asset that we have, and that was really a self-financing deal. As we seek to get bigger in these international acquisitions, that undoubtedly at some point for the bigger deals we'll not be able to finance all of it internally, and we'll turn to the capital markets. Based on what we saw in the recap, we think that we'll have institutional interest in our acquisitions, and we're pretty confident that we can bring high enough rate of return opportunities to the market that we can secure this financing for the existing producing property acquisitions that we're seeking to make in this acquire and exploit strategy. Perhaps it would be a little bit different, maybe more difficult if we were pursuing a pure organic strategy, one that was not free cash flow positive. That kind of growth capital is, certainly more difficult to source than it was in the past. We, recognize we're living the challenges of a small cap company today, but we do think that there is acquisition capital. Every indication that we have available if we can bring the right deals. I'm quite confident that the deals that we do make and the bigger ones that we bring to market are going to be high rate of return. We're very careful as we go about evaluation of the assets that we're seeking to buy, and as we negotiate and structure these deals. Done it for a number of decades, and we've I think had quite a strong track record of being able to develop high rates of return, as I mentioned earlier, in the initial deals and in the subsequent operating improvement on those assets. And every indication that we have is that we'll be able to successfully finance when we do that.
Right, and there's no I guess clearer example than the changing climate in small cap space than maybe Tenaz's balance sheet itself. I mean, you've got 55 to 60 million of market cap, and then you're holding 14 million of what is effectively net cash, which is something you would never hear in 2010 to 14. The companies would be levered up, and they were looking for 3x debt to EBITDA multiples as their low end and whatnot. So definitely changing times, and I think one that maybe some of the newer investors who look at oil and gas are not fully aligned with, because they look at oil and they say, oh, this is a high risk climate where companies could go under, I could lose all my money. But how exactly is a company with 14 million net cash on the books a high risk company? So just something that I think we in the oil and gas industry, both as I guess on your side as management and board, and then on our side on the retail investor side, are trying to get this message across to some of the call it non-oil investors, bring some more interest in the sector going forward. So I guess a- another quick reminder, anybody in the audience, I know you're feeling shy, but if you do want to come up and ask some questions, please press that mic button and we can get you up there. If not, I've got a few more here. We can continue on until the top of the hour there, Tony. And I guess one of the interesting things you mentioned there was that your team, obviously very distinguished in terms of the acquisitions you've made in the past. I believe your excuse me, your corporate presentations mentioned $6 billion USD of M&A activity in the past between your teams. So, what do you see in the M&A market now? There is this lack of M&A that I think some of us are seeing. The question is it because of a big difference between the buyer and seller and what they're looking for? Are the right properties just not available with the right runway and drilling locations? Is there a just lack of capital available for M&A? You mentioned that maybe that is not the problem. I guess any other thoughts you could share on the M&A side of things, especially in Europe or MENA, where some of us have less of a insight as to what's happening in those areas.
Yeah, I mean, if you, I think the useful way to look at this is to look back at the market environment that we've had for the last couple of years. So we did our recap about a year and a half ago. That was in, I think we announced in August 21. We closed it right at the beginning of October 21. And the commodity market at that time was coming out of this huge trough that we had during the COVID period. That inevitable recovery and run up in oil and gas prices was tremendously accentuated by the war, and really even the kind of the run up to the war, end of 21, first couple of months of 22, that just led to this explosion in both commodities, especially in European gas. And when you have that kind of increase in commodity prices, uh, it is, I think, almost inevitably going to lead to a big gulf between what the sellers are willing to accept and what the buyers are willing to pay. Uh, we're a very careful buyer. We're a value buyer. Um, Certainly, we one of the things that we intend to do is to not make mistakes in the technical evaluation of these properties. What we say is we like to try to reduce the controllable risk in these deals as low as is possible, and that's why we put so much emphasis on the engineering, the geoscience, the tax structuring of our deals. We still have commodity risks, though. We still have the commodity cycle to deal with. And what we faced there in the first half, really maybe the first three quarters of 22, was we were still in the midst of or at the plateau of a huge run up in commodity prices that occurred. So during that time, sellers were generating so much cash out of these properties that the kind of offers that a value buyer like Tenaz would make were just not going to be, uh, enough, I think, for the sellers to part with the properties. We made a number of offers, some on quite large asset sets, some multi-country, very large deals, ones that would have actually taken us to kind of a 100,000 BOED rate bogey that I talked about earlier, yeah, in single deals. and a number of smaller deals kind of all across the size distribution. During the first 3 quarters of 22, almost none of those transacted. Some of them were deals in the market, some of them were unsolicited uh, offers that we had made, but almost none of it transacted to any party. And that was just the nature of the market at the time when you'd had this huge run up in prices and maybe unrealistic expectations on the part of the sellers. We did see that begin to change in Q4. We got our first deal done. It had, unusual characteristics because I think of the seller that we had and their objectives and the nature of the property that enabled us to make a very good value deal there. But it also reflected beginnings of the change in, I think, in the asset market. I do think that there are quality assets available, the kinds of things that we'd like to own and have under our control, the kind of product exposures that we want, the kind of technical development opportunities that exist on these assets. Those types of properties are available in the market, and I think that the current commodity environment, uh, which still offers good margins and quite strong cash flows and free cash flows from these properties, though is the expectations in the market today uh, uh, create an environment where sellers and buyers, particularly the sellers of the kind of properties we're interested in and what we're willing to pay for them, have come much closer together, such that when we look at what we call our transaction pipeline today, the deals that are available to us, I think there's a much greater ability to transact, a much higher probability of transacting than we had when we immediately after the recap at the end of 21 and maybe the first 3 quarters of 22. So for us, it's a better market than we had previously. I think the assets are out there within these geographies that we talked about. First Europe, second MENA, third the Americas. And I think there's much greater realism on the part of sellers. And when we make these kind of deep value offers that we make, uh, I think uh, I think the sellers that we're and potential sellers that we're dealing with are much more likely to transact. So it's I would say, a better transaction pipeline than we've ever had previously, with higher probabilities of transacting and still the kind of returns that we're targeting.
Yeah, that's a phenomenal way to put it. And I think one of the things that when I first started looking at Tenaz, it was very interesting to me is that yes, you do have the Leduc Woodbend and you're making these deals, but really you are on the hunt for a absolutely massive transaction that's going to bring the company up to the high five figures or even the low six figures all at once. And that sort of transaction may not be available in North America, but it is available in sort of other assets across the world. So appreciate you giving us the color on that. And then
Yeah,
as
yeah,
far as
and Shubham, I'd say on that we do look all along really the size spectrum. I mean, we did make offers on these quite large deals like you just talked about. We are working though a number of things that are in the middle of the range and in the lower part of the range too. So we're looking for a return, and we're willing to build it at reasonable steps if the very large deal isn't available.
Yeah, no, you better appreciate that color as well. So I think something that people should definitely keep in mind when they look at Tenaz. You're not a company that just wants to grow Leduc Woodbend by 20 or 30% per year. You're looking to get bigger, and especially with your European and sort of global expertise in the past as well with the team you've built. And one of the interesting things that also you mentioned there is I got sent a table from 2012, I think it was, of companies that were at 2,000 to 4,000 barrels per day, and they were trading at 10 to 13 times cash flow. And today we're here. I just ran the numbers on Tenaz, and you're trading at $20,000 a BOE, roughly two to three times cash flow, somewhere in there. So just goes to show when you say that you're de-risking the acquisitions. I mean, the stuff that's out there is available so cheaply from a cycle perspective, that it just makes sense possibly, well, it does make sense for a lot of companies to go that way. So I think we can wrap it up here with one final question. I think one that many here in the room would be wondering is when you look at anything outside of North America or even within North America, how do you properly account for the geopolitical risk? Is it overstated in a lot of cases you find? Are people too risk averse in that sense? What are your thoughts on that? And then we can maybe wrap it up here. Thank you.
Okay, yeah, Shubham, that's another great one and a good one to close on. So uh, there are certain jurisdictions, certainly within those regions, within those continents, that we would not consider. I mean, obviously there are uninvestable ones, and we kind of highlight this with a map in our investor deck, showing that there are a lot of places we have experience that we don't consider investable. Uh, However, I think in a wide range of these other countries that we do color dark blue on our map. Uh, the probably the perception of risk is overstated. There's some degree of risk in every jurisdiction, even in Canada. You can see this in with royalty changes that sometimes occur. Oftentimes overseas, you've got very, very long periods of uh, consistent fiscal regimes, and that has not always been the case in Canada. To use one example, even the United States has its own history further back of significant taxation changes. So I'm not sure that the geopolitical risk is in fact that much higher, or that much higher in these overseas jurisdictions. We do make an assessment of it. Um, uh, I do think that a lot of these countries, with their own balance of payments difficulties that they have in energy, are seeking much more investment into their energy sectors. And for that reason, they know that they're kind of limited in their ability to have inconsistency or have volatility or have a perception develop that they're not good places to invest in the upstream. So I actually think that frequently the geopolitical risk is overstated. Maybe because of this perception and the lack of kind of qualified buyers or capable buyers in a number of these markets, you have much lower competitive intensity for assets. That's why they go off at a lower multiple, I think, than they do in North America, most fundamentally. And it actually works to our advantage. Probably the geopolitical risk isn't as much higher as the asset market reflects, and that's why we're able to make higher rate of return deals at entry. And then certainly you get the greater opportunity for improvement as you go forward with the properties.
Fantastic. I think that's a great point to kind of leave it there. Really appreciate your time here, Tony. It was a pleasure having you on and having a little brief discussion here on Tenaz. For those who are maybe new to the company, at tenazenergy.com, they have a corporate presentation on there which references the map that Tony was talking about as far as the acquisition candidate countries. And yeah, we'll look forward to following the story here as time goes on, and maybe have you back up here at a later point in the year here as well, Tony. So really appreciate your time, and I hope you enjoyed it.
Oh, I certainly did, Shubham. That was a great set of questions, and it was a totally fun discussion for me to have, and look forward to the chance to talk to you again. I thank all the listeners who tuned in as well.
Right on. No, appreciate that, and hope everybody has a great night. And I believe Tenaz also has a investor relations email on their website if anybody has any further questions. And hope everybody has a great rest of the day here. Cheers.
Okay. Thank you, Shubham. Goodbye.